The SCHD ETF is a popular ETF in the dividend growth community for various reasons. For one, the fund's goal is to track as closely as possible before fees and expenses the total return of the Dow Jones US Dividend 100 Index. Now, this is an index of high-quality dividend-paying stocks that need to pass a rigorous screening to even be allowed into the index in the first place. Also, the ETF has a massive starting dividend yield relative to the amount of potential upside the ETF price has, or at least has had historically. Now, this means that investors can expect massive annual returns, at least if the fund performs like it did in the past. But when it comes to SCHD, there's one metric that this ETF offers that I think some dividend investors seem to either miss or sort of undermine. And in this video, we're going to dig deep into this metric, and I want to share why I think it might be the most important of all. Now stick around because we have a lot to go through. Right after you, please drop a like on this video and subscribe for more future content like this. Now the metric I'm talking about is DGR, or dividend growth rate. So dividend growth rate is a measure that indicates the annual rate at which a company's dividend payments have increased over a specific period of time. It represents the compounded annual growth rate, or CAGR, C-A-G-R, of dividends over that period. And the dividend growth rate is often expressed as a percentage. Now, if you were to calculate the dividend growth rate, you would typically take the difference between the final dividend payment and the initial dividend payment, divide it by the initial dividend payment, and then divide that result by the number of years in the period. And finally, the result is expressed as a percentage. So a real quick example of this would be, let's say a company paid a dividend of $2 per share in the first year and then increased it to $2.50 per share in the fifth year. The dividend growth rate over a 5-year period would be calculated as follows. It would be the final dividend minus the initial dividend, divided by initial dividend, divided by number of years, which would give us in that circumstance a 5% dividend growth rate. Now, dividend growth is especially important for investors that might not have all that much money, all that much capital to invest into an ETF like this. Now, this is simply because in theory, what this means is that if an investor was to invest into something like SCHD today, which is paying out a current dividend of around $2.80 or so as of 2023, if SCHD ETF's dividend growth rate continues like it has in the past, that investor will be getting paid more and more money for every single share of SCHD that they own. Now, this means that the only thing the investor would have to do in theory to get paid more and more in the future is to hold onto the shares of SCHD long term and allow the dividend growth rate to really kick in. One of the ways that I like to compare dividend growth to is considering dividend growth like a job. Every few years you might get a raise. Some years you might get a bigger raise. Some years you might get a little bit smaller raise. But the longer you stay at the job, in theory, the more raises and the more money you should earn in the future. And what's cool about investing, especially into a fund like SCHD, is that once you're invested into the ETF, there's no work. It's not like a job where you have to go there, clock in. You just buy into the fund, and at least historically speaking, it pays you more and more year after year. Now, the reason I'm so bullish overall on SCHD, or the Schwab US Dividend Equity ETF, like I said a second ago, is not just the fact that the ETF is up around 183% as far as price return just over the last 12 or so years, but maybe most importantly, it's the dividend growth rate for SCHD. Now, to be more specific about SCHD's dividend growth, the trailing 12-month dividend growth rate is around 7.13%, but the last 3 years, 12.33%, or looking at the last 5 years or 10 years, 13.92% or 11.32% on the 10 years. Now, this is a very important metric, especially for dividend growth investors that are looking to hold on to their investments indefinitely. Not sell off their investments during retirement, not the 4% rule, none of that, for investors like myself that are looking to build a massive war chest of dividend-paying stocks and ETFs, or specifically for this video, a massive amount of SCHD, and use the dividends later on in life to live off of. And of course, hopefully even have extra money to live out the later half of your life exactly how you want to. Now, for the investors out there that do have that as their goal, that want to be able to hold on to an ETF indefinitely and use the dividends over time to cover all their bills and more, dividend growth rate is very important. Now, for those that might be a little bit confused on why dividend growth is so important, here's one simple reason on why it's very important. The US inflation rate, which is around 3.18%, but historically somewhere around 2% per year. So if we look at the inflation rate just over the last few years, of course, we can probably assume that best case scenario inflation will probably continue at around 2 or 3% per year, but maybe even higher as time goes on. So for an investor that's buying into stocks and or ETFs that don't have healthy dividend growth, the inflation rate is going to completely decay all their future potential dividends if things continue to get more and more expensive. But going over the SCHD ETF's dividend growth rate over time, the 10-year time frame 11.32%. Even when things got very, very bad and inflation rose like crazy back in 2022, the dividend growth rate of SCHD in theory would still outpace inflation. But it's not just inflation that makes the dividend growth rate of an investment so important. And specifically in the case for SCHD on why I think the dividend growth rate is crucial when buying the ETF. If we look at a dividend calculator and start with just $25,000 and add $12,000 per year, have DRIP turned on, and have an initial starting dividend yield of 3.5% and an expected annual dividend amount increase of 8%. Now, even though SCHD could have a higher or lower expected annual dividend amount increase, just going with 8% just to be safe. Now, if we were to invest this relatively small amount of money for 30 years, look at what happens over time. Now, before we go ahead and calculate all this and see what numbers we would get from now until 30 years, we have to understand exactly what's going on here. The power of compound interest is what's happening. Now, compound interest is the interest on savings calculated on both the initial principal and the accumulated interest, or in this case, dividends from a previous period. As the investor continues to buy more and more shares of SCHD, along with reinvesting all the dividends that were being paid from the previous year, the power of compounding is really going to take place, and the dividend snowball is going to get bigger and bigger. The SCHD investment would start at $25,000 and offer around $886 per year in dividends. Now remember, this investor is going to be consistently contributing to the portfolio and is also going to be reinvesting their dividends. So the compounding effect is really going to take place. So much so by year number 10, this investment that started with just $25,000, an additional $1,000 per month, and dividends reinvested is already up almost to $190,000 and over $10,000 per year in dividends. Now by year number 20, a little bit further down, $623,000 in principal and already $55,000 plus per year in dividends. And by year number 30, especially for the younger investors out there that definitely have some time on their side, by 30 years in, $2.25 million with over $328,000 per year in dividends. Now I get it, we don't know exactly what things are going to cost in the future. We don't know exactly what SCHD's dividend growth is going to be in the future. We definitely do not know what's going to happen in the future. But just going off of some historical performance, we can get an idea of what things could look like if an investor was to invest a relatively small amount of money and just let the power of compounding do its thing with a specific ETF that does offer a nice starting dividend yield, but maybe even better, an expected annual amount of dividend increase of around 8% per year, which again is even lower than some of the past years. So when it comes to buying into things like SCHD or any ETF for that matter, I really want dividend growth investors to take the dividend growth rate metric as a very important metric to pay attention to. Because even if the investor isn't necessarily super concerned about inflation eating into their cash flow later on down the line, I also know for a fact that dividend growth rate being higher than average is definitely going to allow the investor to see a compounding effect take place for their portfolio, especially if they have a relatively small amount of money to start off with, which, let's be real here, a lot of investors do. But when it comes to the Schwab US Dividend Equity ETF, do you personally agree with me that one of the most important metrics of all is dividend growth rate? And if not, comment down below which metric you think is most important. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.